Good morning, Jen. Morning, everyone. All right, well, why don't we just get going? It's 7:30 a.m. Wall Street time, approximately London lunch. This is your daily Forex Trading Strategy Session. My name is Wayne McDonell. I'm the Chief FX Market Strategist for TradersWay.com. Enjoy the pleasure of trading Forex, but also energies and metals, stock indices, binary options. It's all good in the hood. Why don't you join us? We do these events every single day, Monday through Thursday at TradersWay.com and every Friday at FXStreet.com. Feel free to join us. Today, I'd like to cover technical analysis. Yeah, let's just go through the charts. Let's do our job. Nothing fancy, no songs and dances. Let's just do some good old-fashioned hard work, huh? Let's get going. Now, let me remind you that trading and investing is risky, not appropriate for everyone. Your past performance, good or bad, does not predict or is not indicative of future results. Therefore, whether you're a hero or a zero yesterday, today you should stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Quick trip around the world. Let me look. British pound sort of neutral. Euro mostly weak. Swiss franc neutral. Japanese yen fairly strong. Dollar was weak, then it was strong, and now is neutral. But Aussie strong, CAD strong, Kiwi strong. Just commodities ripper strong across the board. What do you know about that? All right, one thing that's caught my eye is that we got our breakout on the USD CAD. You can see there's our range. We've been tracking that for, I don't know, weeks, months, really. And then we have a breakout. And traditionally, what I like to do upon a breakout, you know, that's clearly below the low. So I like to look for a pullback in that area and then drop it like it's hot. Okay? And we're getting there. Sometimes it comes back a little more. Sometimes it doesn't quite get there. It is a zone. It's not a particular price. It's a zone. Another way of measuring this is with Leonardo Fibonacci's study tool. You'll see a retracement back is a 382. So we're about a 21.4. On a 4-hour chart, we're hot to go, HOTTOGO. You see that? It's ready to turn. Check out the 1 hour. It's already turned. 15-minute. It's thinking about turning again. So if you wanted to buy some Canadian dollar, it's not a horrible idea. So just plan it out the way you like it. Into resistance, lower low, lower high, lower low, lower high, lower low, lower high. Right? Double, well, I guess you can't call it a double bottom, but anyways, lower low, higher high, higher low, consolidate, consolidate, consolidate. So anyways, it kind of looks like it's rolling over to me. Not quite a 382, but that happens. And the reason for it is it's a very strong trend. Now, what I used to do in the past, I'm self-taught. I've never really taken much of a trading course before. So I do a few things quirky. One thing that I did was, in the beginning, is I took 786 and I subtracted that from 100 and got 21.4. and 21.4 is about here, right? So it's a very fast moving aggressive trade. If you take a 21.4. So that's something I do often. Guess it helps with your confirmation bias. If you want to fool yourself into believing your own nonsense, throw that in there too. So what do you stink? That's USD kitty cat. Let's go into the S&P 500. Beautiful 50% retracement. Now we're back up to the top. I would say this is fairly important. Okay. Now, I wouldn't expect the S&P 500 to, have big rallies, but I am bullish and I am buying dips. But remember, we trade globally, so everything is relative. In the Eurozone, they're doing quantitative easing, right? So let's just say Europe. And that's going to positively affect a lot of different European stock markets, whatever you're paying attention to. And in China, they have lowered the reserve requirement again and dramatically. So there's a lot of, easy money policies globally that the U.S. doesn't have anymore because we're done our process. So I would be a buyer, but I'm not expecting huge rallies and stuff like that compared to the other stock indices. Just based on simple, I dare I even call it fundamental analysis. It's not even fundamental analysis. It's just, I don't know, the other central banks are easing. Our central bank is thinking about tightening. It's not really tightening either. It's normalizing, but I think you get the point. It's the opposite. But because things are good here, where the other one's sort of like phony baloney, funny money kind of rallies, but free money's free money. I don't mind it, right? Do you guys have a problem with free money? People tend to spend it even more than real money. So that's sort of, the reality of it. So, I'm a buyer, but it's more like a holder, or buy and hold. Let the long-term fundamentals. Okay. Now, what's the big deal with the reserve requirement ratio? Is that a big deal? Yeah, well, in the United States, we never touch RRR, right? We never touch RRR here. We manipulate interest rates. Which one has a bigger impact? Yeah, RRR. In fact, if cutting interest rates is a bazooka, RRR is a nuclear bomb. Far as a shock to the system. And a full percentage point, like they did in China, is redonkulous. So let's say the entire banking system, I don't have a drawing tool. Maybe I'll fire that up while we're just chit-chatting about this. Let's say the entire banking system had $1 million in it. Now, clearly, the Chinese banking system, with all the deposits of all Chinese citizens, is a little more than $1 million, right? But let's see if we can do the math here. Waiting for my drawing tool. And does anyone actually know what the interest rate is? The official interest rate in China? Not the prime rate, but the central bank rate. There you go. I'll just make up a number here. Not that mostly just because all central banks are in a situation where nothing is normal. Like the new normal is abnormal. Abnormality is the new normal. So hang on. Let's go crazy here. Let's clear the charts. Let's pull up something I'm not going to use. I'll pull up an oil chart. Yeah, I was going to pick 5% anyways, so hang on. Loading. Okay, we'll just pick this chart. And I'll go templates. All right, so we briefly discussed this yesterday. The money multiplier is 1 over the required reserve ratio, required reserves plus excess reserves. Okay. So let's say the $1 million bucks, right? No big deal. I didn't have this planned out, so I just went fast. Hopefully I don't mess it up. I have a crappy calculator. Let's use that. All right, so let's just compare here. If the required reserve was 6%, okay, and then what happens if the required reserves are the ratio of deposits at the central bank to overall deposits is lowered from 6% to 5%, like China did yesterday? What's the big deal? Let's say excess reserves is 0. Oh, it's not going to let me do this. It won't let me drag that. Now I can't find the calculator. Oh man, I can't. It's not going to let me use the calculator on top of my drawing tools. Gold, dang it. Well, someone else grab a calculator, right? Should have used Linux. Well, typically you'd use an Excel spreadsheet or something like that, but right? So 1 over 0.06. What's that? Can someone bust out a calculator? I can't do the calculator over top of the drawing tool. In fact, I drew it over top of what you see here and the calculator's disappeared. Can someone confirm? Okay. So what happens is the total money supply jumps to 16,666,000. 666. Okay. Because of the fractional reserve banking. So what happens is there's $1 million total deposits, 6% goes to the central bank, and the rest gets loaned out, and that gets sent to someone that wants to borrow it. They're allowed to borrow the money, so therefore, let's say people buy a whole bunch of cars with the money. The cars go to the car dealers, and the car dealers deposit that in their bank account. 6% gets sent to the central bank, and the rest gets loaned out, and that goes to a different bank, and that bank then takes 6% of their total deposits, and that gets sent to the central bank, and the rest of the money gets loaned out and loaned out and loaned out and loaned out. And $1 million through the fractional banking system gets turned into almost 17 million. What is 1 over 0.05? Now that the R has been lowered from 6 to 5. So now 1 over R plus E takes us from 1 over 0.06 to 1.05. What's the answer now? What is 1 over 0.05? Okay? Now, $1 million in the bank spread out through the entire economy is now 20 million. A change of what? 3.3333 million. Is that statistically significant? What percentage is 3.333 of 16.6666? This increase of 3.3 million in a 16.6% economy. What does that represent, guys? So this little thing that China just did, this little thing over the weekend that you maybe read and you didn't really understand, like, oh, they changed the RRR. They increased their money supply by 20%. There's 20% more money in China today than on Friday. I don't know, what do you think? In a multi-trillion-dollar economy, is that a big deal? Yeah. Yeah. Does that help put it into perspective? Does this help them actually understand the math? This is what central bankers are doing, and they're doing the calculations and stuff, and they're like, well, if we want to have such and such impact, how much money, and if we change the RRR, and how will that increase? And I mean, it comes down to math, right? So eventually you're going to have charts. You're going to say, all right, the money supply here, that's the money supply here. We're going to shift this over by increasing it, right? This is money over here. So we're going to shift it over to money supply 2 by increasing the money, changing the reserve requirement ratio. We'll change the money supply by 20%, and the slope, the money demand curve, is going to change, and interest rates are going to be down here instead of versus here, and you get interest rate 1 over interest rate 2, and you can get some fun math in there. But that's what's going on at the central bank when they're having meetings and stuff. They're trying to figure out what they're going to do, what impact they want, how much is going to do what. But everybody, you like that quick on the fly lesson? How about this? Are you getting that information anywhere else? I mean, honestly, I don't know. I don't attend any other sessions besides mine. So, all right. But that's that's the math side of it. Cool. Right on. So we all good? We all good? Right on. Nice. All right, cool. So there you go. That's what happened over the weekend. Now you know. Gold, yeah, up, down, turn around. So seems to me we're really just doing nothing, and that's fine by me because that's what I've been saying gold is going to do. Is I'm a bear, but I don't think it's going to fall far, and I'm not a bull. So it's just, I keep telling people, there's got to be something better to do with your money than gold. And so anyways, it's moving up. It's still basically 12. How are we doing on this? Well, moving right along. Not massive changes right now, but this is what we planned out yesterday just to kind of put it in perspective. I think we should move this over here though, right? How's that look, eh? All right. So yeah, so nothing's changed there as far as I'm concerned. Gold, nothing's changed there. S&P 500, really nothing's changed. But the big change is that we are holding at the places we needed to hold. When we were down in this box in the S&P 500, I said it had to hold. If it didn't hold, it was going to be a long way down, and I just wasn't emotionally prepared for such a retracement. But the logic was nobody benefits from that. People, the vast majority of market participants make money on the way up, not the way down. So that's got to hold. Well, it held, and then it held again, 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 and then a higher high. And then we're like, yay, and then it came down, and we're like, oh. But then, here's that area that we'd like it to hold. And it did hold, it did hold, it did hold, it did hold. So hopefully we kind of do like we did in the recent past. We kind of make that our future. We move a little bit higher and just consolidate off this resistance. It maybe becomes support. And we're just kind of up here for a month. Nothing dramatic, but higher. Well, it's like, are you going to buy oil, Wayne? That is between me, myself, and I. What I say here is it makes a lot of sense why it's going to go higher. Doesn't mean I'm going to buy it. That's your alpha. But I can tell you this gray zone where to the left of where it says sell oil here, we drew that in last year. Bottomed out, we fibbed it, and we had that even though we were bouncing around here for 6 months. We had this sell zone already done, so I don't see why it can't come up to our sell zone A and then come back around. It could go a lot higher. That's just a 382. Like even that, I'm not suggesting anything except that would be a logical area to sell. If you want to get into the fundamentals of it, peak oil tends to be June 1st, and then oil supplies dwindle. But we're reversing this. We have tons of oil supplies. Typically, this is when you build up oil supplies in anticipation of driving season in the summer in the United States. So if you look at the historical charts from the Department of Energy, which I have, typically the buildup is increasing as we're creating more and more stockpiles of oil in anticipation of increase in demand. And more oil supplies tend to lead to lower oil prices. Well, we have higher oil prices now. And then once you hit June and the driving season starts and we start drawing down our supplies, then very often that could respond into higher oil prices, because now demand is increased and we're dwindling down supplies. And that goes all through the summer. And then if it's a cold winter in the Northeast, they use a lot of heating oil, and suddenly, there's, now we're talking about a crack spread between various petroleum products, but nonetheless, crude oil has a greater demand as we go into a cold winter season and draw down more supplies, and that goes until springtime, and then everything starts to warm up again, and we take the opportunity as demand for these energy products dwindles, we start to build up oil supplies in anticipation of summer driving season, which continues till approximately June 1st. Everybody knows that, right? So anyways, this is weird because we have too much oil. We can't even build up oil inventories any higher because we're already at 100% of inventories, right? And yet prices are going up. So there's something else going on here besides logical supply and demand. Guess what? The efficient market hypothesis has failed again. Something illogical is going on here, according to the information I have in my brain. But nonetheless, I still think it would go up. And if it does go up, I still would sell here as a technician. That's all. Just simply as a technician. Technical analyst, boom, sell it right there. Why? Because that's what they would do. I mean, that's just Fibonacci and some other things, right? Why not? That's how you make money. Coolio? Coolio. Okay, let's take a look at pig yen. Piggy, 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 can't you see? Sometimes your pips just hypnotize me, and I just love your trading ways. Yeah, lots going on here, eh? So here's our head and shoulders. Remember, this white zone is the predicted top of the head and shoulders pattern that we did about a week ago. I think it was probably last Tuesday. We anticipated the right shoulder before it happened, and it did happen. And if that had happened, we suggested based on the neckline to the crown, right, the distance from here to here, which we brought over with this projection from the neckline, we popped it up here and said in the future this would be our target, and price went up there, hit it, stopped, came down, went through it, stopped, and came back, and then for the third time tested out our target area. So that pattern fulfilled beautifully. What do we do now? Well, now you got to change your fractal, and somebody's on the 786. So there's a last sort of desperate attempt to keep this down. So, you know, it's easy. You have to decide if you're a bull or a bear. If you're a bear, that was Alamo. If you're a bull, you should probably have it fibbed so in a way that that you rebuy. And we have this marked here. So it came down, we're floating on top of the 3A2. And I'm fine by that. And if it came back down into here, into this white zone, I would buy that too. So it looks like two sort of logical scenarios here. A move like this is really an idea if you're a bull. Now, depending on how far it retraces before it extends, will determine whether it breaks this top or not. Okay. So, for example, if we found ourselves back into this zone here, I would buy it, but I would expect it to top out here. If it held where it is now, okay, so we have this move, it came down, I'll still call it a 3A2, then I would assume through the roof. because the quality of the retracement will help you anticipate the quality of the extension. All right. Do 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 do. I guess we got to do euro, right? Do we have to? Let's leave euro for last. Are you guys still trading euro, or did you give up on it? You know, I say if the fish are jumping in the canoe, you should go fishing even if you're sick to death of eating fish. You know, whatever, dude. Just keep eating. You'll appreciate it one day when the drought hits. Okay. You know, sometimes, guys, the Forex market can be feast and famine, where for 3 or 4 months you don't even sleep because it's just like trade, 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 trade. You're just, oh, the markets are moving fast and furiously, and you know you're picking stuff up in Asia, and it runs all the way through to the New York session, and then you're stopping and reversing in New York, and you're just everything is going and it's all moving. And then you can go 3 or 4 months where nothing happens. So sometimes, hey man, if the fish are jumping in the canoe, it's your job to pick the fish up. Now in my book, I talk about 800-pound gorillas guarding all the banana trees, but they're so fat and lazy that they drop bananas, and you need to be a cheeky little monkey to run in there, pick up the bananas, because the big 800-pound gorillas are too slow, too fat, and too stupid to care otherwise. Let them climb up the tree and do the work for you, and you'd be a fool to fight them. There's the other analogy, and of course I'm talking about central banks. So right now, if Draghi wants to give you free money, I don't see why you would refuse it. So anyways, here's support that I have on USD yen, and I'm pretty sure we've talked about it several times. I've gone through periods where I've bought dips like this for 6 months. It just does the same thing, up, all the way down. Up, and then you're like, oh, we broke out, yeah, oh, and it comes right back down. And I'm emotionally prepared to just keep doing it. It's just, it's seasonality. I'm prepared to just keep buying dips, jamming, fine. And so with these yens, you almost need to be almost a day trader in the sense that you're buying the dip, get out at the top, and then just play it again. Just reset until you get, let's say price did this now, and then you got clear trends, right? And so I would expect it to be in a range for 4 months. That's how emotionally prepared I am for that. I would like to see this. This is what I'm hoping for, right? That's what we all want, I think. But I'm emotionally prepared to go with reality, and that's sort of the orange lines where you just up, down, 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 up, down, down, down. I mean, if you go back to last year, there were times when I was up like 350 pips, and rates came back. I mean, it's just amazing. On breakouts, you're like, oh yeah, we finally broke out, and a week later, you're like, I can't believe that we retraced. It's just, but I stayed calm. How many people were with me last year around that? All through August. My message last August, and I don't think it'll be the same this year. I don't, and I hope not. But actually, logically, I don't think it'll be the same. But last year, I actually told people, don't expect to make any money whatsoever, but I want you to trade. I said, you need to decide, are you going to shoot at rabbits or are you going to set up traps for big game? Literally, this is what we talked about. And I said, what I want you to do is create a yen basket, trade yen trades, in this case, long anything with a yen on it on the right-hand side. When you're at hardcore support, you still need to do your technical analysis and stuff, right? But move your stop to break even and don't take profit. And I said, just do it for the month of August. And just as an experiment, just long-term trend trades only. You're not in it for the pips. You're just in it to build a portfolio. And I said, if you're lucky, some of your trades will survive the pullbacks. And you'll just add another one and add another one. But do not take profit in August. Take profit in October, November, and December. And just throw away the month of August as far as pips are concerned. In your mind, that's not the point. And decide not to shoot at rabbits. Because I said what might happen is you make lots of 10 and 20 pip trades, and then all of a sudden September, October rolls by and the markets have moved 1,000 pips and you got a couple of hundred pips to show for it. Then you'd feel stupid. Versus, the 100 or 200 pips you made in August, if you're lucky, right? So anyways, what happened is the yens actually did break out right near the end of August and September, and quite a few traders that were hanging with me suddenly had 10 open positions that were moving 100 pips a day for 3 months. Because they set things up using long-term fundamental analysis, buying at long-term technical support and having the strategy of leaving them open. Now that takes, some would say malice aforethought, right? You planned ahead. And you had a strategy, right? You planned ahead and had a strategy, and that's the same anywhere else. That's going to help. So in this case, I'm kind of similar. Like I understand that markets change, and I need to change my strategy according to market conditions because the market doesn't damn about me, and it's not going to change to benefit me, right? So I think it'll probably move sideways between 118 and 121. Could be for many months. I don't know, but I know what my job is. My job is to continue to look at the long-term technical analysis and the long-term fundamentals of macroeconomics and central banking policy and decide whether I'm a bull or a bear. And if I'm a bull, I buy at support, right? So that I risk as little as possible. And then over the course of time, I remove the risk by moving my stop. Right? You see what I mean? That's my job. Where it goes, I really have no more influence unless I add more money to the market, right? But even then, I could go all in and have no impact. I'm just not that big. I don't have $1 trillion. But I'm still going to buy a support that even a blind man can see. And I think on the long run, I'll be all right. Okay? But even more importantly, I anticipate that it could happen. I'm making, in this case, range bound. I anticipate it could happen. I'm emotionally and logically prepared for it to happen. And I know that I'm buying at support. And if it breaks out to the upside, which is my fundamentals are saying that, it should still continue to do that, then hopefully when it does, I'll have a bunch of trades. So imagine, let's say I bought here and my stop's at, down here. and I survive this first pullback, and I buy in here. So now I got 2 stops jammed, 2 positions open. This one comes all the way back, knocks me out. Okay, I still have this one open, right? So eventually, so then, so I buy again in here, and one day it breaks out. I could have this trade and this trade, maybe a following trade, and then it breaks out and pulls back and takes off. And I could eventually have 4 or 5 or 6 open trades going in the direction of the long-term trend with the fundamentals behind me and maybe earning an interest. Who knows? And those would be long trades. The second way of doing it, like I was suggesting, is make them day trades. Buy, get out. Buy, get out. All right? Buy, it failed. Buy, get out. Right? Buy the dip, good, get out. And just play it that way. Just take the money. Both are okay. One, you're shooting at rabbits. And sometimes that feels really good because you're making money. And then sometimes it doesn't feel, but sometimes the longer term trades pay off way more money. But then also you can get in scenarios where you're in a long-term trade, you bought at support, and it knocks you out either on this pullback because you moved your stop closer, like maybe you should have, or you held on for dear life and it came back 100% knock you out. And then you say, oh man, well, if I'd only taken profit, I would be more profitable versus break even, right? So instead of beating your head into a brick wall and saying, no matter what I do, it never seems to work out, pick one or the other. Just say, what if this moves sideways for 3 or 4 more months, that we're in a 300 or 400 pip range? Do I want to be a long-term holder, right? Do I want to build a portfolio is what I was teaching people back then. Building and managing portfolios was what we did last summer. Do I want to be a portfolio manager or do I want to be a trader? And then just pick the one you want to be. Whatever sounds good to you, and usually it just sounds right to you. If you're a trader, day trade. If you want to be a portfolio manager, build a portfolio. Right? And that's where I say, so, tell me about your positions. And then euro. Let's go to a euro chart. Mike's like, clearly a day trader. Cool. Okay, euro. All right, so the topped out at exactly 618 Fibonacci retracement with a lower low followed by a lower high, followed by a lower low, followed by a lower high, followed by a lower low. Are we going to get a lower high? Hopefully. The challenge sometimes in these situations is the reverse fibs, and we're in fib wars. So this kind of zone that we're in now, let me mark it. This way. Oh, man, I did it my old-fashioned way. Anyways, this is an area of concern. Roger that, Lord. Yeah, this is where the enemy troops are laying an ambush for you. Because think of it this way. If you were a bull, you would buy this, right? Is there any doubt? If you were a bull? Can we have like a clear, definitive answer? Right? We can't have wishy-washiness. Oh, but maybe, but. I mean, if you're a bull, you buy that. What's wrong with you, boy? Because that's what bulls do. If you don't do that, you just don't know what you're doing. Right. Goes like a bear. Yeah, well, but that doesn't mean a bull wouldn't buy there. There are bulls in the market. If we didn't have bulls, there would be no market, right? There are bulls. Now, we might disagree with them, but that's our alpha. That's our ability to outsmart the market, okay? But I'll tell you what, the difference between an investor and a trader is a trader knows what bulls are going to do, even if they're a bear. They know what the bulls are going to do before they do it. Therefore, they already have a plan for it. Imagine walking out to a battlefield and you're the general, and you've never even thought about the enemy's point of view. You're going to walk out there with your plan, and your plan's going to go to crap, and they're going to slaughter you, right? So I think if you're a general, you say, okay, well, what do I want to do? And more importantly, what are they going to do? Where are their fortifications going to be? Where are they going to from? What are their strengths? What weapons do they have? What can we counter? Right? So you need to understand your enemy. And you need to anticipate what they're going to do before they've even done it. They're probably still planning it, and you're already doing the same thing. You know how they're going to. Anyways, if you're a bull, you just have to buy there. If you don't buy there, you're just not a bull. Okay, that's a beautiful retracement area. That's definitely a buy zone. All right, so but you're a bear, so what do you think is going to be the end result of it? Oops. Now I got to do a fib of a fib of a fib. So I would like to say this now. By the way, this is what, Elliott Wave, they say he was a genius. The guy's a genius. Yeah, he was just doing stuff like this. It's just simple fractal geometry. I figured it out on my own. But anyways, that's all because we have this big wave. So I'm a bear. So I'm thinking, generally speaking, right? But we know these big moves have micro moves in them on every time frame, and that's what fractal geometry is. So you have all these smaller moves, right? You can see there's lots of fib retracements there. Then it consolidates and higher, high, higher, low, right? Higher, high, higher, low, higher, high, higher, low. And then we get up to here, and then it consolidates and lower, low, so on and so forth, right? You have all these little micro moves, and then you have medium term moves and stuff like that. So I'm just suggesting now that there's an opportunity for, because people are going to buy here, we're going to bears now are going to sell the fib of the drop this way. And that if there's more bears than bulls, the bulls are going to buy it up, and we're just going to drive them right back down. Now that's just Fibonacci, but then I start to look for things like pivot points, pivot point clusters, let's say weekly and monthly overlaps of pivot points. I like to look at psych levels, all that kind of stuff, and throw that in there too, and that'll tell you sometimes whether it's going to be a 618 or a 382 or 786 and all that kind of stuff. But you should be paying attention to what market participants are anticipating, and they're looking at this zone here. Okay, thinking down, up, and then down. Okay. So if you're bear, you can't sell now, right? So you sell later. So that's what I'm thinking. How about up in New York, down in London? So there's 3 fib studies, and it all makes sense. Okay. Now, if I'm wrong here, it's going to be wrong in the direction of the fundamentals. And what that will suggest is just essentially just straight down. I mean, obviously we know there's lots of little moves, right? And it just keeps going, right? It just keeps going, and you don't get a big, 618 Fibonacci retracement. Well, then you need to be on the game. You need to be there. You need to be ready. Okay? Most ideal situations would say that it's going to come back, retest this old support area, and then drop. Okay? Now, is that a 382 or a 618? Well, I had it as a 618, but I was just measuring from here to here to here. Okay? But this is important too, isn't it? Or how about the weekly central pivot point? Is that important? Or maybe it's going to come, like I suggest, and go to the psychological level of weight. Which one is it going to do? Well, that's why you need to be there. All right, so you see the layers of, right? But that's why I say somewhere between, let's say, the 382 and 618 Fibonacci retracement, if I was a bear, I would sell. Boom. Enough said. Okay? And then when you, if or when you get into your sell zone, right, your AO, your area of opportunity, you drop into a smaller time frame, certainly not a 4-hour, drop into a 15-minute, right, let's say. Let's say you're in the sell zone, and so we're up here now, and on the 15-minute chart, it just rolls over like this. What should I do? For how long? This is where shooting at rabbits becomes a problem. Some traders will sell this and pick up 25 pips. And they're like, oh man, I'm awesome. Everything is awesome. I'm the world's greatest Forex trader. Everything, right? And then what? It's not 2 hours because we set this up on either a 1 hour or a 4-hour chart. You're taking the trade on a 15-minute chart, but it's not a 15-minute trade. You're just lining up price action and selling when the 15-minute is way overbought and rolling over at resistance. But on a 4H, on a 4-hour chart, you see that as a sell zone based on a Fibonacci retracement. And we're right here. And if you're selling, let's say let's say you're selling a 618, so it came all the way back to 108, like I said. So it went to the psych level, made a 618 Fibonacci retracement, and you sell it. Well, the 618 is going to predict a 1382 on the 4-hour. So you could be short for 24 hours too. And that's what I'm saying, where you don't want to pick up the 25 pips and say you're awesome and miss out on 75 pips because you just did, right? You were on the wrong fractal. Okay? So it's actually worth 100 pips. You got 25 and everything is awesome, right? No, it's not awesome. All right, why don't we wrap up here? It's been, I think, 55 minutes. We'll take it easy today. Unless you have a question, I'm happy to answer one. In fact, let's do that. Why would I be so lazy to quit 5 minutes early? That would be lame. Got any questions? I'll stay for a half an hour if you got them. All right. Pig dollar. Pull up the pig dog. It shouldn't be too different. See, I look at everything's correlated, so I give you enough information to figure everything out, but I'm happy to go through that. All right, so are you a bull or a bear? Okay, so you're bearish on the US dollar? You're a bull, you're bearish on the US dollar. Yeah, I have to confirm, right? So I will look at pound dollar if you're bullish on one and bearish on the other. So if we're long pound dollar, you need to tell me you're a bear on the US dollar. Okay? If you're a bear on the British pound, then you need to tell, or bearish on this pair, you need to confirm that you're a bull in the US dollar. Because sometimes what I find is people want me to do the pound dollar, but they're bullish on both. So who actually asked about pig dog? Where did it come up? Who asked about, where is it? Oh, yeah, Oris. Okay. Okay, so Oris says he's a bear on USD, bull on the pound. Okay, good. That's all I need to confirm. Yeah, well, we already had this planned out. And we're on the 382, so this is a trade plan from earlier. So, yeah, we're good. Okay, we did this a few days ago. So here's what I see. I know this is a very messy chart, but there's a lot of analysis. This is how I have it set up. Okay, just to make it stand out a little more. This is how I have it planned. Yeah, sort of neutral. Yeah. Okay. Yeah, and also when I say something like that, like are you a bull or a bear on this on the U.S. dollar? Well, on what time frame, right? So just the way that it's been behaving, it's, we've come down to support and consolidated, reversed, made a higher high, came back to the apex of the wedge from the higher time frame, and using that as a launching point. So yeah, that's a bullish entry for sure. Okay, and the target would be, the bearish entry would be here. This is where the bears are. Okay, and notice how the 50% retracement predicts going into this zone here. And the funny or interesting thing about it is that's a 618, that's a 786. So if you were a bear, you would have to sell in this area. You would have to. This is your Alamo. Because if we go above that, there's nothing left for bears. There's nothing. It's over. Okay? So a bull would certainly buy this dip right where we are now, up into that zone. So that puts you in 149 with a target of 152 to 154. So I know they're messy charts, but I think you follow, right? Jen says you don't think it'll, well, it could, but that doesn't change the fact that it's a buy zone. Could it fall farther? Yeah, but I'm just looking at some basic things. I'm looking at the apex of the wedge from our previous trade plan. Okay. I'm looking at the psychological level, which should act as support, and I'm looking at the 3A2 Fibonacci retracement of the bottom to higher high to higher low. So anyone that's traded with me for any time knows that that is an entry for me. I set up a buy zone. This is just classic. Okay. Where it goes from here, I don't know. If it came down to the 618, yeah, it'd have support. I'd have to change the chart again, but yeah, okay, that kind of thing. Sure, that might be a second chance opportunity. Third one would be buy it off this bottom again, depending on the price action. But I'd play the range. I'd play the 618. I'd play the 3A2. Sure, there's a lot going on here. I mean, I'm pretty certain I planned this one out for you guys several days ago. Hang on, let me bring this up. Let's look at it on this chart. Yeah, I mean, I can't be any more clear than that, right? There's we did this yesterday. I mean, it can't get any easier than that, can it? What do you think of this one, guys? I mean, right? Horace? Okay, yeah. So I don't know if it's going to work, but I mean, it's a trade plan, right? Well, see, you're looking at it on much smaller time frames, I think, Jen, where I don't care the way it behaves for the last 9 hours. Who cares? It doesn't change the fact that it's a buy zone. Hourly 200 EMA, weekly central pivot point, 3A2 Fibonacci retracement after a higher high. It's just, I don't know, it's just pivot points. It's just Fibonacci. It's just price action. I don't care about anything else. Right? Like the noise on smaller time frames, 5 and 15-minute chart, to me, it doesn't even matter. It just doesn't change the long-term stuff at all. And by long-term, most people will laugh because, I say 1 hour and 4 hours long-term. They laugh at that because to them that's scalping, right? And then some other people will say, well, what about the weekly chart? What about the monthly chart? I'm like, I don't care, because the fundamentals have changed. This is a part that I don't understand how some technicians get so bothered by it. Because I'm like, well, you're looking at something that happened 9 months ago when we were still doing quantitative easing and we were worried about the taper and the effect of the taper. We're through the taper. We've been at no quantitative easing for quite some time, and now the market's worried about when are they going to raise? When are they going to raise? It's a completely different world than your weekly chart. You're looking at past performance and past data, but you're missing out on the past sentiment and the past concerns of the market participants. You're just looking at candles, price and time, and to some degree they're important, but without also the reasoning behind it, they're much less important. Now, support's always going to be support, But why are we at support? It's going to be much different from why we were at support 18 months ago than why we're at support now. Okay? Because I believe fundamentals create and drive the trends. Technical analysis just puts you in and out of trades. So the fundamentals have changed, and so I tend to I tend to look at the daily quickly to just discern things like where the 5 EMA is, and then I'll pay much more attention to the 4 hour, but I just look at them and say, still a bull, still a bear, whatever the situation is, and then I drive down hourly and 15-minute, but I already know what I'm going to do now. I'm already a buyer. So if I'm on an hour or even this 15-minute chart, I see the weekly central, I see the 382 after the higher high, higher low. It's price action, it's pivot points, it's Fibonacci. It doesn't matter to me. I'm long, I'm gone. All right, next. And just keep moving. So, all right, now we've done 1 hour and 6 minutes. So instead of quitting 5 minutes early, I stayed 6 minutes late. Cool. Now that's the me I like. Peace on earth. May the pips be with you. May your profits be above average. Thank you for being a client of TradersWay. If you're watching the recording on YouTube, or actually any of the recordings, if you watch any recording, any video for more than 5 seconds, then you should leave a like, you should leave a comment. Okay? Pay it back. Love you, babe. Thanks for being on my team. Why? Because you keep me sharp.